Welcome back to our second session of the day. I'm pleased to introduce Randy Rowe as the moderator of this panel. As people have heard me say over the years, can everybody sit down? Okay, please sit down. Thank you. As people have heard me say over the years, one of the seminal moments in the success of our 12 real estate summits has been Randy Rowe's assistance over the years in helping us put together panels like this one here to my left. Randy's going to introduce the speakers, and before I give it over to Randy, I just want to let people know there's a great innovative and disruptive technology in the real estate business called Bisnow on Business. And people don't really believe when I tell them that Bisnow is the name of Mark Bisnow. And we have here with us today in the very front of the room my friend Mark Bisnow, who is here. And that is really, stand up, Mark, Bisnow on Business right there. Randy, all yours.
So this morning we were assigned the topic of change, which the previous panel got pretty heavily into, but hopefully there'll be lots more to cover. As is our usual approach to this panel, Roy is going to start by doing an overview for us of what's happening more broadly in the capital markets and investor appetites. But the thing that struck me this morning when Jay was talking about how the first iPhone was 2007, I think would be a good benchmark for just how much things have changed. When we were preparing for the panel, we were talking about what were things like 10 years ago in terms of a whole set of criteria versus today, and where do we think they might be 10 years from now? I mean, obviously, Dale started to hit on some of those things with things like autonomous cars. But the key this morning is going to be we're going to try to cover multiple property types. We're going to try to stay with more specific examples of what the theme is that a particular asset demonstrates. And we're going to try to leave 15 or 20 minutes for questions at the end. We're also going to try to get us back on schedule. So it's a mix of criteria here. So with that, I'm going to do very quick introductions. To my far left is Roy Marsh, who we're going to hear from first. I think everybody knows that Roy is the CEO of East Hills Secured. He's probably sold more trophy assets than anybody else in the country over the years, including having sold the business a couple times. I keep waiting for the next rendition of that. To his left to his side is Mike Fascitelli. Mike now is listing himself as the owner of MDF Capital. I assume you had a big branding expert help with that name. So we're excited to have Mike here. Deborah Cafaro is next to him, obviously has built a behemoth REIT in the healthcare and assisted living and senior housing space. And then to my left is Jeff Farber, who's, Jeff Barkley. Jeff Barkley, who is managing director of Goldman Sachs and actively buys all property types, I believe, these days. So with that, we'll get started with Roy, and Roy will do an overview of what's happening out there in the capital markets.
Great.
And his slides are available if you contact him afterwards.
Great. Thank you very much. And what I tried to do is look back at some of the slides and presentations that I've done over the last probably 4 or 5 times that we presented, and to try and do a little compare and contrast amongst and between some of the changes that we're seeing in the market today. But specifically focusing on the bigger capital markets questions, which are how do you find decent returns in an environment where the 10-year is trading between 240 and 270? And ultimately, will the cash penalty strategy that the Feds deployed ultimately be enough to dampen the effects of tapering, which we've already begun to see their indications, and the ending, obviously, of quantitative easing? We're in the 5th year of a recovery, and the question is this more like 2004, which was the beginning of that last hockey stick ramp up, or are we at 2006 in the cycle? And then how much longer can we have a 2.4 10-year in an environment where we're actually seeing GDP growth at around 3%, a little bit greater than that, and unemployment finally has subsided to 6.1%, although real unemployment versus unemployment statistics tend to ultimately change the outlook going forward, and I think that that's what we're seeing from the Fed. A lot of international capital, and I'm going to talk about how that affects structures these days, and that's something that's new, and it has to do a lot with our legal system and FIRPTA. But the U.S. is a very, very, very attractive place, probably second only to London, relative to the focus of global capital these days. And the reason why is that the legal system, obviously here, is there's a rule of law, which we've talked about before. QE tapering, we're actually coming out of it, so people are beginning to get a sense as to where we're going, but that has a big impact on a lot of the developing countries. They're not able to handle that adjustment quite so easy. And then the political concerns that are going on not only in the BRIC countries, but also countries that are surrounding or nearby some of these BRIC countries. Slow growth in Europe. Obviously, one of the things to watch, I think, is this election coming up in Scotland about trying to, in essence, secede from the UK. And that could have some knock-on effects, we think, in terms of Europe in general and specifically in the UK. And so watch that. But the slow growth in Europe has definitely created an opportunity for the US as a safe haven. Poor demographics in Japan, slow growth just generally. And then another positive at the end of the day, which is that our growing energy independence. While we're not there completely, we're getting there. So all that is really, really, really good news relative to what's going on and, and at least the flight of capital to the US in general. And we are seeing economic growth, and it's not across the board, as was mentioned in the previous panel, but there are these pockets, and it's particularly the coastal markets, technology-driven markets, energy, healthcare markets, and intellectually driven markets. And those markets are getting the multiplier effect. There's great growth, and then we've got the Fed policy driving and keeping rates low, and so you've got the multiplier impact coming out as a result. And then overall, just very, very little supply. And again, save the multifamily markets, which are pretty quick to build. We've seen very little new supply in terms of retail, in terms of office and industrial overall. And at the same time, the US economy is $2.6 trillion on a nominal basis, larger, 20% than it was in January of 2007 when we hit the peak. So where are we headed from here? Well, the bond markets are predicting low rates for some time, 3.20 for the next 3 years. Interestingly enough, if you look back into June, the market was predicting 3.8% for 3 years. And you can see it's a very, very flat curve when you get outside of the kind of July, excuse me, of 16 and beyond. There's some speculating that that's a 5 to 7 year phenomenon. If that's the case, we're going to have pretty benign rates for the next 3 to 5 years, which on a relative basis, again, I think portends well for the real estate investment environment. Just to put it in perspective, and some of this candidly doesn't make a lot of sense. Germany, okay. France, I don't know. How in the world can France be at a 1.25% 10-year? Ireland at 1.65, recovering, doing well. In many respects, kind of got ahead of the unwind for their banks and their financial crisis early. Maybe a little bit more well-deserved. Spain, how in the hell is a 2% interest rate environment? Italy, 2.25, below the 2.4 of the U.S. So the global bond rate market is not providing yield, and when you put that together with the security of the U.S. market, we're seeing just a flight of capital. Again, you've seen this slide from me before. It hasn't changed much, which is part of the good news, I guess, at the end of the day, which is in order to compete with this 10-year Treasury at 2.4, we think that the Class A core real estate at a 6 IRR unlevered is a pretty attractive alternative, and clearly we're seeing people even dip into the financing markets, and you can get an 8.5% return, or 3 to 3.5 times what you can get in a Treasury market. As you all know, trying to catch up from the beginning when you've got a great cash on cash is a lot harder if you're sitting in a Treasury at 2.4. Debt market, and again, the debt markets drive a lot of the equity markets. So where are we? Obviously, a tremendous amount of liquidity. Spreads have tightened as the 10-year has moved back into the 2.5 range. Strong interest across the board. Life cos, bank cos, CMBS, mortgage REITs and mortgage funds. And as a result of the search for yield, people are going out on the risk curve a little bit more. And so there's a growing availability for transitional assets today, growing construction loan availability, and a deep market for subordinated debt. We'll talk a little bit about whether or not people are actually going as far out on the leverage as they had historically, but it's certainly available. So debt originations, again, 2014, pretty similar, we think, to 2006. We think it's going to be right around $400 billion. I think the CMBS market, which in this is right around 110 billion, is probably a little optimistic given where we are in the year. Having said that, there's a lot more conduits out there and people trying to ramp up. It's just a question of whether or not it'll actually get through by the end of the year. But we feel like the debt markets are going to be in and around 2006. CMBS volume up 80% in 2013. And we expect it to be around, again, $100 billion. Now, 39 CMBS lenders. When we look back, that is a record number of conduit lenders out there. We've seen, again, as they are searching for yield and trying to figure out where they might be able to add value, that the floating rate CMBS has materially improved. And the CMBS for single assets has provided really, really strong pricing for large assets, particularly in some of the major markets. This is just, again, a snapshot of where the yield curve is today. The green is September 2014. Spreads have tightened as the market's gotten comfortable with the taper. But you can see that there's still a lot of room to run, we think, in terms of spread compression if and when rates do increase. And you can see here, even in the AAA, it's 3 times what it was in 2004, 2006 in terms of where spreads are in September 2014 versus kind of on average 2004 to 2006. So we think that that's going to have potentially a dampening effect. If base rates do go up, we're going to hopefully see some spread compression in the market, and obviously providing then we think base rates that will be reasonably benign over the course of the next several years. Bank lending, again, strong, growing demand for bank balance sheets, significant liquidity given the fact that the consumer demand is fairly flat, and growing interest from Asian banks and increasingly so from some European banks, which are important in the syndication market, and as I mentioned earlier, a growing availability for construction loans, and a deep syndication market amongst the banks, particularly, again, for transactions that are larger. This is, again, a snapshot in terms of liquidity in the system. You've seen this before, and it's only grown. It suggests that there's $2 trillion in excess of the existing capacity that's being utilized that could be available. Again, there are regulatory issues that are a dampener on this, but there's significant room to run. Today we have $1.3 trillion in commercial real estate loans versus where we were in December 2007 at $1.6 trillion. And the deposit base has, as I said, grown significantly from $8.4 trillion to 11. So we think that the banks are going to be at it with positive spreads for some time. And then just in terms of kind of debt is back, and to give you a sense of how things have shifted, the number of lenders that we've closed deals with just this year, 71 lenders, whereas in 2007, and these are different lenders, whereas in 2007 there were only 46. So a lot more players. And the complexion and composition, I should say, of that is changed dramatically. It's almost inverse between the CMBS versus the non-CMBS, 75% back in 2007 and just about 32% today. The interesting thing is where is leverage today in terms of how high you can go in the capital stack and what that ultimately costs you. So 80% 10-year fixed rate, taking a senior and putting the mezz in, You can borrow today at a 4.80 coupon versus a 5.75 coupon, so almost 100 basis points less than you could back in 2007. And clearly in the floating rate market, you got a 300 basis point benefit in all that. Now, having said all that, we are not seeing a lot of people take this level of leverage. People are sneaking up into the 70, 75% range, but we aren't seeing people take this to a significant degree, which is a good sign, because when people start taking the leverage, even if it's cheaper, you start getting nervous. So what does that all mean relative to current loan pricing? And again, Class A, office, retail, industrial, at least the core food groups, 10-year, 60 to 65%, probably around 4%. And ultimately, again, a 5-year floater fixed to swap, a swap to fixed, 60 to 65% is going to be around 340 to 350 fixed. So very, very low nominal rates, which ultimately are quite accretive to current cash returns, as well as overall IRRs on a levered basis. What's changed in the debt markets since we last met? One, aggressive warehouse lines and CLOs enabling these debt funds to tighten spreads, and they're playing predominantly in transitional assets, development deals, redevelopment deals, and the like. The floating rate bond demand is allowing the CMBS to compete with the banks in transitional assets. Improving fundamentals has increased the construction loan business, and insurance companies in particular originating senior mezz as their quest for yield continues. So the equity markets, in terms of what is going on as a result of these trends and these flows, overall very active, very liquid, velocity accelerating, strong global demand here in the U.S., growing confidence in absorption and rent growth. I would say it's getting to the point of aspirational relative to that, but as a result, that's where people are beginning to play as they see the sovereign wealth and the larger pension funds that have core aspirations beginning to price them out. Growing demand, therefore, for vacancy and a hope that the economy will improve. Pricing's recovered, at least on a rate of return basis, to 2006, 2007 levels and higher for most institutional assets. In fact, in some of the major markets, nominal values, not just rates of return, are exceeding the 2006, 2007 levels. There's still a spread, we think, in some of the secondary markets and some of the non-traditional primary assets. We think that the CMBS market's drifting into that space and will narrow the gap. The quest for yield is beginning to drive capital into less traditional asset types, right?
We consider ourselves a major.
You have evolved into, as a result of your phenomenal management team, evolved into a traditional asset type. And when you see the returns, that you're having to compete with these days, it's certainly not a bargain out there, and certainly not a bargain for people who aren't able to manage them well. JVs are on the rise, and I'll show you a statistic that's a little surprising, particularly for large lot size transactions. And again, to reiterate, new supply is still quite low. So sales volume, we are back to 2006, and if you actually take out what I'll call the EOP effect, which was about a $90 billion impact, we're relatively close to stabilized, or not stabilized, but back to 2007 volumes. And that continues to increase, and I think that with rates where they are today and with the flow of capital coming into the U.S. in particular, that you'll see this continue to be on an upward trend. We're 20% plus ahead of where we were this time last year, and so I expect it will actually be at this close to $300 billion level. My comment earlier about the dearth of new supply, it's really against the 14-year running average, and you can see in office 53% less new supply versus the 14-year average, 75% less in retail, 40% less in industrial, and as I mentioned earlier, the apartment business is still able to get those things put up pretty quickly and a little closer to equilibrium, but those are things that you just need to watch, but also keep in mind that there hasn't been a lot of new construction out there. That isn't an excuse to build irresponsibly. It's just a fact of life. So the offshore trends, this is a slide on sovereign wealth funds just to give you a sense for the buying power of these folks. So $6.3 trillion total, and if they were to allocate 5% of their overall portfolio into U.S. real estate, which is a trend. If you see the government of Norway, the government pension Norges, it's $878 billion, I believe, up there. It was, when we met last time, it was about 640. It's growing at a rapid rate. There's about 11 people, I think, that live in Norway, and so they're covered. Their beneficiaries are pretty well covered, and but what you'll find is that in the U.S., for example, with FERPTA issues, you've got the inability to really do much more than 49%, and so they're partnering. And but if you look at all of these sovereign wealth funds, and they're dominated by the Asian market, I think 6 of the top 10. There's about $600 billion in buying power that's sitting there waiting to be deployed. Now, as I tell people who ask the question, they're a mile deep in terms of the capital that they have, and they're about an inch wide in terms of the human resources that they have dedicated to the effort. And so you have to get their attention, keep their attention, ultimately, or else you'll never get anything done. They tend to run around in circles until they've got something identified. Oops, going the wrong way. And then this is a snapshot in terms of, again, what's changed between 06, 07. 06, 07 had a huge burst of Australian investment, mostly in retail. And you can see today the fastest growing is Asian and Canadian. I joke oftentimes, I said, Peter's in the room, and I think Neil I saw earlier as well, but you know, one of the shortest trips to a sovereign wealth fund or a pension fund is to go to Toronto. The Canadians have been a big player. They tend to understand our markets well. And most of them are at this point in this stage of their evolution trying to put together full platforms here in the U.S. But a growing Asian influence, obviously, from the offshore market. And then this is primarily driven by FERPTA here in the U.S., which is, in terms of deals between 2013 and 14, over $250 million. There were over 100 that totaled about $63 billion total volume. Roughly 46% of those were structured deals, which meant they were likely to include one form or another, an offshore group. So understanding what works, what doesn't work in terms of control and all the rest, but this is a big change in the marketplace. In terms of the public markets, again, balance sheets stronger than they've ever been, high equity issuance, M&A activity growing, and then the private REITs, which will surprise, I think, some of you in terms of how formidable they've become and how institutionalized they've become. They're a real impact in the market today. REIT balance sheets, again, very strong. This is the slide that surprises people, which is if you look at the amount of equity raised the trailing 12 months by non-traded REITs, over 50% of the total equity raised in the REIT industry was raised in the non-traded REIT space. They are monsters today. There's a big consolidation going on, and it's something to watch. And a lot of people, including Sam, poo-poo it because they feel like it's a scam on retail investors. But when you look at what they're actually doing in terms of being able to provide an access point for investors to get the kinds of returns that they'd like to get versus what they're seeing in their CDs and bank accounts, they're actually getting those things done. And when you've seen them resolve now in a lot of the more recent transactions, you see that they're actually paying out at par to a premium to the par that they were actually invested in. In terms of pricing, again, this is kind of the Green Street mark in terms of temperature, but 84 bips has been the spread currently. It's about 92, pretty similar to where we were in 2004. In terms of where overall pricing is, the Green Street Commercial Property Price Index, we're at 111% of peak in the aggregate. It's skewed by malls, multifamily, strip, and industrial. Office is just about back to par, and hotels continues to lag somewhat, but again, gaining ground. So in terms of midpoint pricing, Gateway, this is where we were in 2007, a 5.25, 7%, 7.4% IRR. Today, 5% at 6.25. You'll see a lot of green on the right-hand side. This is in terms, and these are all midpoint pricing in terms of all this. But you see the IRRs are down, and cap rates are about the same as where they were in 2007 for office. Mall retail, huge move. And this is really, when we say Gateway, this is really more fortress. There's a big spread, and we'll talk a little bit about it, between the $700 a foot plus versus the $400 to $450 a foot retail. Open air retail, again, big compression. Grocery anchored, big compression. Industrial compression. Again, not so much on the cap rate, but a lot more on the IRR. Multifamily, here's where we are. And then the net lease space, and this is, as I mentioned, quest for yield. A lot of people moving into things that they might have considered specialty back in the day. And some of it's been driven by this non-traded REIT business as well. But you can see we're at a 475 for a 10-year today in terms of the going-in yield. Deborah, senior housing, healthcare. This is the 4th year. Finally, I got it in there. It's a mix between senior housing and healthcare, but you can see at a midpoint of about 6.25, it's a very aggressive market out there and has slipped itself into the traditional asset classes. Hospitality, as I said, still a laggard. In the end, rates are a concern, but they're still attractive on a historic basis. And I think that if you look at the supply, limited supply, no immediate signs of overbuilding, and if rates do go up, we think that there's enough spread to dampen the effect of rates going up in terms of the overall pricing effect. And then you've got to look at, why are rates going up? If they're going up because there's economic growth, that probably means that you've got NOI growth. And if you look at it versus a core investment at a 6% IRR, over a 10-year period of time, if you get a 1% NOI growth, it offsets a 1% increase in interest rates on a nominal basis. And so looking at interest rate growth and its impact on pricing isn't necessarily a negative, as long as the reason for the growth is coming from the right area. Debt availability is continuing to grow. Levels are approaching 2007, but cheaper. Everything's up. Cap rates are relatively low, but not dissimilar to 2004. In the primary assets and markets, pricing is near or beyond peak. The question is, again, how far do we go? It feels like it has some legs. And then again, looking at transitional assets, the quest for yield continuing to push people in other directions. US and London will continue to be choice core markets for global investors. Structured transactions will continue to play a large role as long as we have FIRPTA, and as much hope as we have for FIRPTA every year. I always feel like we're kind of on the 2-yard line until it's time to punch it in, and then we seem to go backwards on it. It's not all a bad thing, by the way, the FIRPTA issues, because it makes for a good partnership in those situations as opposed to an outright sale. And then at the end of the day, I guess we feel like, given this trend line, the market, will continue to compete favorably versus all the alternatives. I had an opportunity to give a little presentation like this to Stan Ross's group out in Southern California, and this is all kind of an upward trend and looks all very, very positive. And I posed the question, what happens when and if the music stops? And the first little bit I put up was, it's a cycle. It'll come to an end, as all real estate cycles do. How many in the room think that it's going to be as a result of a cycle? So everybody over 40 raised their hand, right? So I said, okay, what about a snap event? It could be terrorism, it could be an earthquake, it could be, global unrest, it could be cyber terrorism. How many of you think that? Well, from 30 to 40, everybody raised their hand. And then I asked, how many think that this is just a paradigm shift, a new normal, and happened to be in Orange County in PIMCO's backyard? And everybody from 20 to 30 raised their hand, which is why we're in the real estate business at the end of the day, right? Because everybody does have a different view, a different opinion, and money can be made in transition, and money can be made right now with where rates are today. So with that,
Thank you, Roy.
Yeah.
Okay. Mike, why don't we start with you? Mike?
Yeah.
He just said that's the most fucking bullish thing I've ever heard.
Roy, through the years, I've never seen a presentation that wasn't bullish from you. So,
I've never seen cap rates go up.
and never predicted them either. Yeah. So, Mike, you've bought a lot of office buildings over the last 15, 20 years with Steve. When you think about what you were buying years ago versus what you would buy or build today, what's changed about, Steve started to talk about the locational changes, the space changes, the user needs. Where do you see things today versus then, and where do you think things are going?
Well, I think we've seen big shifts, as Steve mentioned, in tenant demand. We bought a building on Park Avenue before the crash, and rents were, we pro forma rents at in the low hundreds. They went down to 60s during the Depression. They've got back up to 90s. We didn't buy a building in the meat market. Rents were 60s, and now they're over 100. So the west side has shifted. So, people, if the building quality, the building on Park Avenue was much better, doesn't matter, the location of the other building. So our underwriting, I think, just missed that 7 or 8 year trend. Secondly, you have new buildings, all these new buildings that go on Hudson Yards and downtown, which are taking a certain tenant that wants to consolidate, get more efficient, sacrifice probably location, traditional location, and basically do that. So there's a lot of trends going on. And the biggest trend that's put a damper on the office market is people consolidating their operations into less and less square feet. So it is true, and this is true in DC, where Mitchell went with the government, the square foot per person has made this cycle of office damper because people have cut their office rent, the space use. So it used to be in New York, when you had that depression, you have a spike. You haven't seen that spike because of those trends. So like Steve said, things are changing.
There was a while there when people were moving towards tech space that people worried about the credit quality of a lot of the tenants, but I assume at this point you're seeing more credit in some of these alternative locations than what you were.
I wouldn't go that far. I walked through one of these buildings and a couple of these buildings in Chelsea and Midtown South, and there's nobody that looked like us in these buildings. Nobody. We look like we're going to a funeral. They were. If you go to San Francisco, Roy and I were talking about this. Jeans and a T-shirt were a good dress. So, and I didn't recognize half the names, and when I don't understand what the business models are, like I didn't in the .com, it concerned me. When people. So I don't think you could. There may be better capitalized startups or better capitalized operation, but I wouldn't get that confused with credit.
They still don't have cash flow.
No.
I think one thing that's different is that it's not confined to San Francisco and New York anymore. So if you look around the country, if you look here in Chicago, obviously, if you look in Austin, and you look in Seattle and Portland, and you look in Minneapolis, which is a city we've just invested in, where the same factors that we're talking about and Mayor Emanuel was talking about are at play to keep people in the city. So these new neighborhoods aren't just tech. They're creative, that's the term, but they're marketing and they're financial services. Companies that want to locate into those areas, some of them actually are pretty creditworthy. And if you take Google in New York, for example, you've got the Google effect multiplying not just Google, but you've got serious companies that have business models that do have revenue that want to be nearby. So I'm not sure that it's what we experienced in 2000 and 2001 that we naturally could be afraid of.
Yeah, Randy, I think that two examples that I would give. One that I think had a major impact on kind of New York City and the perception of New York City in terms of what its major industries ultimately were and its future. And I think 111/8, to a large degree, created an opportunity for New York to reinvent itself with Google acquiring that, and sort of the knock-on effect that's occurred in the neighborhood and it becoming their, in essence, urban campus. And I believe that as a result, you know, there are more people who'd rather be in New York City, in the Chelsea area, you know, going to work there as a cool place to work than, you know, being in a suburban, you know, campus environment. So I think it really had a big impact in terms of how people viewed New York City. Another example of people changing uses and image for their employees, 550 Madison, the Sony building, where Sony, who had 800,000 square feet, wanted to consolidate, as Mike mentioned, down to 550,000 square feet. But they wanted to actually move as much for their employees, because 550 Madison, built as the AT&T building, and the Sony headquarters was a corporate facade and a corporate environment. And they're at 111, they're going into 111 Madison ultimately, and consolidating smaller space, cooler space. And they feel like for their business model going forward, they have to offer that up to get the best employees at the end of the day. So this transition about how people use space and why they use it differently, it's not only because of the basic business model, it's also from a recruiting perspective important.
So Jeff, one of the things that this has done is it's greatly broadened the definition of an institutional asset. You know, what now can be bought for institutions because of all these changes. Do you think that's fundamentally being driven by, you know, by traditional metrics and you know, credit and demand and all the rest, or is it being driven by the influx of capital and people needing to find a place to place the capital, or you know, how sustainable is this trend, and how do you feel about that as you go and make new investments?
Well, I think, first of all, your question implicitly is, are people searching for yield in non-traditional assets and thereby making a mistake? My answer to that is I don't think so. Okay. I think Debbie's here to prove that on the senior housing and the healthcare front. But more broadly, you know, real estate competes for capital with a wide variety of other investment asset areas and verticals. So if you look at hedge funds, if you look at private equity, if you look at credit, if you look at the more traditional alternative assets, they're all in a pricing crisis now. There's a tremendous amount of pressure to invest there. And so on a relative basis, even to them, not to mention to stocks and bonds, real estate is attractive. And so the question is, you know, how do investors find return and safety in real estate? And I think that's what investors, both U.S. and institutional, are asking themselves. I think the answers are a much wider selection than they used to be. Look, no one's really investing that much, I hope, in big box retail. Big box retail was just something that sounded good in the late 80s and the 90s, and things changed and it didn't work out. But if you look at most of the other areas of sort of non-traditional real estate assets, they've held up pretty well. And they've earned their way into the sort of institutional, if not the core space. So I think that the long-term trend is to bring more asset types into acceptable range. There's more information about them. You know, RCA follows them. Now Roy has, you know, more rows on his sheet. And I think with that,
that's only because Debbie kept pushing him.
I don't believe that for a second. Okay. So I think you're going to see a continuation of that trend and not a reversal.
Right. So Debbie, compared to what you were doing 10 years ago as you were building the business versus what you're buying today, what's changed? What's different about your approach?
Well, some things are similar. Obviously, our business, which is healthcare dedicated, but in multiple subsectors, is driven by U.S. demographics. So the over 75 still growing at 6 times the rate of the population, and the baby boomers, 79 million of them, becoming Medicare eligible. So that is a powerful tailwind that we have in all of our businesses, although it affects different asset classes differently. We also now have the Affordable Care Act, which is going to bring 25 million new insured individuals into the healthcare system in a hopefully more regular, lower cost way. But when you look at the actual assets, there have been a number of changes and improvements in the way people think about healthcare assets. So starting with skilled nursing, what I would say is that asset type it's not your grandfather's nursing home anymore. These are typically in institutional quality post-acute assets. We don't even use the term skilled nursing anymore. Those tend to be much shorter length of stay, really rehab facilities that people go to after they've had a hip replaced or a knee replaced and so on. And those are really the highest and best use now for the boxes that may be 30 years old. The stock in skilled nursing is on average at least 30 years old in the US. But the uses in the inside of the building is different, and that's driven a lot of changes really inside the building in terms of private rooms, more space for rehab and so on. And sometimes, in some cases, the assets are dedicated to that high acuity population. Other times, you may have separate wings for a more conventional long-term care patient population, and then the rehab where people are staying maybe 7 to 25 days, let's call it. Medical office, similar, very significant developments. I would say the medical office building that you think of where you go in, there's 1 or 2 physicians, it's a small space, the doctor has his stethoscope. That is really, again, we're moving very far away from that. So now you're seeing buildings that are 50 to 100,000 square feet. You're seeing huge clinical uses in those buildings that used to be in the hospital, now they're moving out. Again, all of this is clinical activities that used to be in the hospital, which is the highest cost setting, moving in the case of rehab and post-acute, and then doing procedures and the like in medical office, moving to lower cost settings. And that's a trend, a policy trend in the US. So we're seeing bigger medical office buildings, we're seeing bigger spaces within the medical office buildings as you have these large foundations and multi-specialty physician groups. And you're even seeing the way they're laid out. We have one in San Francisco that's called a theater setting where you don't really see the doctors, and the way the building and the floor plates are designed is very forward-looking. And the last thing about medical office I'd say is you're seeing the large urban hospitals basically building a hub and spoke approach where they're in these large community, 50 to 100,000 square foot buildings, but they're in the communities and they're offering almost mini hospital-like activities within those buildings, but they're sponsored by the hospital. They're not, again, you don't see your 1 and 2 doctor office in those buildings anymore. So that's been very significant. And then in our bread and butter senior housing, which is a private paid business, very much like the apartment business, if you want to think about it that way. Again, adding much more physical amenities, selling a lot to the baby boomer children of the residents who are going to be moving in there. Lots of great common areas. The rooms, like apartments, continue to be pretty small. Again, I don't know what the seniors are doing in there, hearkening back to Sam and Steve's conversation. We try to keep an eye on that, but I would say...
You're not calling Sam and Steve seniors, are you?
They're actually
No.
Okay.
They're
Exactly. Although,
There's something to look forward to.
exactly.
Or at least to brag about.
Exactly. So there's a real move towards...
When you say you keep an eye on that, how do you do that? So,
technology.
It is an issue, believe it or not. But I would say that more physical architectural beauty in the buildings, better common areas, more amenities, and then more technology too, Wi-Fi. I mean, nothing super forward thinking, but Wi-Fi and electronic medical records too that we're seeing in the seniors. And then finally, seniors tend to age in place. And so many of the buildings were built as independent living, or they were built as assisted living, or secure Alzheimer's units. Now, because people tend to age in place and become a different kind of resident during their stay in one of our communities, there tends to be more of a menu of offerings, both from a physical plant and a services standpoint in senior living. So lots of change to serve all these different resident and patient populations. And I think more to come as the baby boomers really become that 75 or 85 and over.
Jeff, what have you bought recently that was different than you would have bought 10 years ago?
We've bought here in Chicago for the first time in a long time. Proud to say.
Congratulations.
Thank you. River North. What else?
Good.
And we bought in Minneapolis in the warehouse district. And so we see that as a sustained trend throughout the U.S. And you know, the comment before about secondary cities, primary cities, what's happened, I think, to the business community since the recession has been a tremendous example of adaptation and resilience. And if you look at a lot of cities, I mean, Detroit may be the most obvious example, and the story isn't over there yet, but it's looking a little bit better than it might have looked 2 or 3 years ago. Cleveland, despite LeBron returning, people are now talking about downtown Cleveland. It used to be sort of a regular joke. So I'm not going to go out on that far of a limb, but there are cities that have been called secondary, and that's a derogatory term, that are around the country that have put together the packages that Rahm Emanuel was talking about, that have education infrastructure, that have transportation infrastructure, that have highly educated workforces. And you know, no one mentions Denver these days. Denver has become the #1 city in a number of very important measures that has not been well noticed. So I think there's a diversity, and we've invested in all the cities I just named, we've been investing in. So I think that's very different than pre-crisis, when the focus of not only domestic but offshore investors was very, very much on the major gateway cities. And if it didn't have 24/7 in it, you know, why bother? I think that's a profound change.
So, Mike, that's different than the strategy that you'd been pursuing. You guys have been...
I wanted to comment on Jeff. Just take Chicago for a second. We bought the Merchandise Mart 16 years ago. I think it's a really interesting example of a building that went through many different phases in that 16 years. I will say, if you look now, the Merchandise Mart is valued about 3 times what we paid for it in that time frame. And cash flow has gone up about 60%. Yeah. So actually more of the gain came from cap rate compression, but it changed dramatically the demand for that building, River North. We built several apartment houses around there. It's a stark in contrast to what tenants are looking for. At one point, 200,000-foot floor plates, we couldn't give them away. Now they become hip. All the exposed ceilings became cool and hip. Rents there are higher than they were, you know, when we were leasing to traditional office tenants. And then the cap rate for the building, because it became more accepted, more, it wasn't as specialty asset, wasn't in the wrong location, went down more than just the average market. It went from 8 to 6. It got into a more normal cap rate. So you know, that's just an example of the changes that reflect the broader market. That asset happened to be, now whether that will continue for 10, 15 years, that's a different question.
Well, and tell how the use changed, who the tenants were and are. It's totally different.
If you go, and the other thing is, I spent the day, how many of you have been in these shared incubator spaces like WeWorks or anything like that? Yeah. How many of you have been in? It's worth going there for a day. Yeah. We had a business called Power Space, which was, if you go, or Regis, if you go in there, it was all closed offices with some common secretarial, food and so forth. You go to these other spaces, they're open environments. Again, Sam's overdressed for these places, Sam Zell, you know, and you go in there, it's all communal, there's a ping pong table, food's available, it's not your own office. For unemployed guys like me, they were trying to track that. And, you know, so one of my buddies goes, go spend the day in this office. I was traveling. I walked in there, I hear in the morning, got there about 9:30, people said, what's the old guy doing here? You know, and they were like, people ignoring me, I was doing my work. It looked like a communal table. I was doing stuff. I went out and see a couple of buildings, came back, saw that people were going to lunch. Someone asked if I wanted to eat. You know, literally I was the oldest guy there by probably 15, 20 years. I came back from the lunch and people had Googled me. The rest of the afternoon, they spent me time trying to pitch their ideas of investing in their business. You know, they wanted not millions of dollars, 100,000, 200,000, 250. $1 million. It was fascinating. Everybody
Shark
there
Tank.
was doing that in a very open environment. I mean,
In which city was this?
I'm not going to say you'll know the thing, but if you go to Chicago in the incubator space in the mall,
Yeah.
or WeWorks
Yeah.
in San Francisco, and they've been the biggest taker of space on a percentage basis in the last 4 years in the office business. Those places that are doing that, totally obsoleting what we did in Power Space 10 years ago, totally obsoleting that. So there's these dramatic change. Go there for a day. I'm telling you, it will be,
Energizing.
leave after lunch. Don't go back after lunch.
Stay through lunch, because that's when the beer kegs are open, and they're right there on the floor.
And then at the end of the day, they were having a beer. Look, literally, they were at 5, 6 o'clock. They were having food and parties and so forth. It felt like you were in a kind of campus environment. You know, that's a relatively different change, Randy, than I think we would have predicted 10 years ago.
Okay, we've got about 15 minutes left, so we'll take questions now if there are questions. Can we get a hand from anybody who wants to ask anybody in the panel anything?
You got started too early.
If not, we're going to keep asking them up here. All right.
There's one back
Oh, there's
there.
one back here.
Curious, to the Goldman person, how do you envision building out the real estate investing platform this time around versus last time around? Any similarities? I say that with no insult, just curious.
You sound like you are.
I'd start by deferring the question to Mike, but no,
I
won't go there. I won't go there. Look, our platform is in what's known as the investment management division, and our focus is entirely on investors. It's a different focus than the merchant banking model that really began in the early 90s and was very, very successful for a very long time. I think that's the primary difference. A second difference is that because of the expected rate of return and what they were looking for versus what we're looking for, we're staying sort of closer to the core plus value added space. And the third is our platform invests not only directly in real estate, but we invest in other funds. Because our view is we don't have all the answers ourselves, and there are plenty of great managers and funds out there. So we have what's called an open architecture business where we actually invest in a wide range of some name brand and some not so name brand funds. So I think those are the major differences.
Other questions? All right. You know, Roy, as we were kidding you earlier about how you were always an optimist, and then during your presentation, you actually did make the comment there was one thing that would begin to make you nervous. What other things would start to make you nervous if you were a buyer instead of an intermediary here?
Yeah, I think that people believing that there is no change out there and believing that trees grow to the sky. I often joke that because we're in the distressed debt business as well, we've got the wood, you know, so whether it's caskets or bassinets, we can take care of it. And candidly, a lot of that is what we're doing in Europe with the European banks and some of the German banks, Spanish banks, and the like. And there are these trends that you see where people have, you know, over-leveraged and mismanaged their commercial bank portfolios and have been nationalized and all those kinds of things, where they didn't believe that you know, things could happen. And I put up a couple things which are, you know, watch what's going on in Europe. I mean, it will have, again, a knock-on effect potentially in terms of growth here. But we've seen, you know, every time something bad happens in the world, treasuries tend to go down. But it will have ultimately an effect on our economic growth if something happens in the UK and in Europe that depresses the ability to grow. There's that fine line between, you know, being able to benefit from it and then ultimately being impacted by it. So I think it's being aware of all these big trends at the end of the day. The other thing that I would say is that one of the bigger changes, I think, over the last you know, 12 to 24 months is the dissection of these buildings because of the relative values of residential versus hospitality versus retail versus office versus leased fee interest and leasehold interest, that there isn't a building today that you look at and just say, well, unless it's net leased for a very long period of time, you know, here's what the cash flow is going to look like and this is what the building's worth based on an IRR. Sony, for example, again, that building was looked at by a multitude of people for residential conversion at the top, 5-star hotel in the middle, a retail conversion down below, selling the leased fee interest at a lower cap rate than the leasehold interest might go for. And so the dissection of a building today and or a property is probably more prevalent than any time in the past.
One of the things, Mike, that you were early in was you were early at the intersection between operating businesses and real estate. And we're seeing so much more of it now. When you look at what's getting classified as readable now and the types of assets that are coming in now, many of the assets have a high operating component. Now, in a public format, I assume because they're together that works, but it seems in a private format, when you're investing through the private markets or you're investing through funds, that might be a little more difficult. And in some ways, you know, Debbie, what you've done is very much of an operating business intersection with real estate. Isn't that a big change here in the last 10, 15 years, the degree to which that's happening?
Yeah, I think it'll continue. It's more specialization. The financing costs also are driving it. You can finance real estate much more aggressively and cheap than you can a toy business or a timber business or, you know, any of these specialty REITs that are coming on. And the non-listed REITs that Roy said are really a factor. So I think in Debbie's business, a good example of the maturation of that. That cost of financing has come down and the cost of equity has come down dramatically for specialized. But there used to be this arbitrage, Randy, both in financing and in multiple that still exists. If you look at, you know, REIT multiples that, you know, they're almost at all-time highs, 18, 20 or more. And corporate multiples are 6, 8, 10, gaming, hotels. So the continuing separation, I think, is going to, as long as the arbitrage exists, I think will continue. You agree, Deb?
Yes, absolutely. I mean, the PropCo-OpCo splits are a foundation of healthcare, but I would say that, and that arbitrage does exist, but then as the operator's multiple comes up and our multiple comes down, obviously that goes away and it has to be a different kind of game. Healthcare is right there. I think when you do that kind of investing, though, you really need to have, even though you're investing in real estate at the top of the capital structure relative to your tenant operator, you really need to understand, almost like in a private equity sort of way, those operating businesses and understand both the sustainability of the cash flows, the strategy of the management team, because what you are doing, what we do at Ventas is we are capital providers to the healthcare and senior living business like a private equity firm, but via ownership of real estate. So it's a little bit of a different skill set and investment model. I think you can deliver outstanding and outsized returns actually with less risk, but it is a business when you get involved in these kinds of real estate assets, there is, I would say, specialized expertise that you have to bring. And one of the issues with cap rates coming down is I think you do see a lot of investors coming in to healthcare who really don't bring that to the table. They're treating it almost like a net lease business or something like that, where I think that's where you start to be a seller a little bit to people like that.
Well, I would take what Debbie said even one step further. I think that's true not only in the specialty businesses, so-called, but in real estate. I think one thing we learned going into the crisis with Enron and Arthur Andersen and many others was that credit is credit until it's no longer credit. With retailers, you know, think about retail credit. That's an oxymoron in many areas. So what I think has happened in real estate investing post-crisis is it has become more like private equity. And when we are underwriting assets, we're not just going into the credit of the tenants, but understanding the business of the tenants better. At the end of the day, it's about sustainable cash flow and what kind of businesses they're in and how that's going to contribute to the NOI of the property. So I think that's a much more important trend or a more global trend than just in the specialty areas.
But Randy, when all of you take Roy's slides and you go home, it looks like it's very toppy, right? It looks like we're somewhere, whether it's the 5th inning or the 8th inning that Sam and Steve were talking about.
It's a doubleheader.
Yeah. I bet you there's zillions of people Roy has sold buildings for on the building, but no one here alive if they bought a building from Roy. So, the truth of the matter is, if you look at that slide, one transition for me is using my own money. And if you have to feed machines like the pension funds or the REITs or the businesses, and you're doing on a relative basis, as Jeff said, investing as well as absolute, because it's very tough to stay in cash. I think the biggest thing is it's a relative game going on right now, not an absolute game. And, and then one of the guys I knew really well said, nothing focuses the mind like writing a check, your own check even more. And when you're writing these checks in this environment, if you were here last night, how many of you were here last night, hearing that guy talk about the problem, you'd be like trading places. Sell, sell, sell. I mean, we just bounced that off. So it looks to me really, really frothy, and doesn't mean it won't go on for 2 or 3 years. It doesn't mean you can't make good relative returns. But if you're writing your own check, beware. I think, and I love Roy, but even beware even more when he's the guy selling it to you. You know?
All right. We have time for one question, or we're going to wrap it up. Anybody else before we wrap? Okay, thank you very much.